you and good morning. I'll start by my personal experience today. I failed to buy bread for the kids. All the shops in Kwadza and DZ were closed, the major shops. The tax shops had some few goods, but they were not selling. And after that, I saw when I was coming to work, a lot of people were stranded. A lot of passengers were stranded. There was no transport, and the commuter omnibuses were charging from $1 to $1.50. And when we asked them, they said they were now buying fuel on black market at $2 per liter. So these are my personal struggles today when coming to work, and also as I was preparing for kids to go to school. And I think this is shared by many of us. And this is the reason why we are here and why we are going to talk about what we are planning to do as the ZCTU. So may I firstly welcome you and thank you for coming to this press conference. As you are aware, on the 1st of October 2018, the Governor of the Reserve Bank, Dr. John Mangunja, and Minister of Finance and Economic Development, Professor Mtuli Ngube, did a first by presenting the monetary and fiscal policies respectively at the same platform concomitantly. Highlights of the measures put in place include the introduction of separate FCA accounts from Nostro and RTGS funds, purchase of fuel in Zimbabwe by foreign truckers in foreign currency, a policy allowing individuals to sell their immovable properties to buyers using offshore funds, review of the intermediated money transfer tax from 5 cents per transaction to 2 cents per dollar transacted. The Zimbabwe Congress of Trade Unions is deeply disappointed by the measures announced by both fiscal and monetary authorities that will worsen the plight of workers and Zimbabweans in general. The new measures, instead of solving the economic crisis that the country faces, increases taxation and fail to find solution to the cash crisis and high price of goods and services, amongst a host of issues affecting workers and the general public. The introduction of a 2% tax on every dollar on all electronic transactions, which has a direct effect of overburdening the already overtaxed and underpaid workers. The people have no option but to be bled by this move, which would also create a fertile ground for a multiple-tier pricing system that spares the cost of living, as retailers and service providers would pass on the cost to consumer. We are chiefly frustrated with the policy directive of separating the foreign currency account, FCA, from the real-time gross settlement, RTGS, accounts, which amounts to treachery by the monetary authorities, who assured account holders that US dollar was equal to the bond note. In fact, Dr. Mangunja said, if bond notes fail, I will resign, but he's still clinging on. Workers and individuals who had earned their salaries in US dollars are bound to be prejudiced by the distinction of accounts. There's also a huge possibility of salary distortions, erosions of workers' contributions that were made in US dollars from 2009 and mortgages hovering over. This has created serious uncertainty amongst workers, reminiscent of the 2008 savings plunder, whereby investments and pensions were eroded. We once reminded the monetary authorities of our reservations on the unilateral introduction of bond notes. Labour had proposed adoption of the rand, which could be realistically rated against US dollar and could restore measurable value, but the authorities refused. It is agreed that the center of the current economic crisis are fiscal imbalances and how they have been funded. This challenge has had destabilizing implications on not only to the financial sector, but to the rest of the economy. The financing of the deficit was mainly through domestic borrowing, with the use of instruments such as treasury bills, overdraft with the central bank, cash advances from central bank, arrears and loans from the private sector. Such financing mechanism is crowding out the private sector, hence constraining production. This also increased money supply in the economy, translating into exchange rate misalignment and inflationary pressures, now at 4.9% as at August 2018, according to official statistics. The financial policy statement shows how fiscal indiscipline since the end of the Government of National Unity in 2013 created domestic debt from as low as US 275.8 million in 2012 to current levels of US $9.5 billion, with an external debt of US $7.4 billion, bringing the total public debt to 16.9 billion. By separating FCA accounts from Nostro and RTGS funds, government has tacitly accepted the reality of different currencies in operation in the economy. One where the physical multi-currencies apply, and the other relating to electronic transfers not backed by any physical cash. This creates an elite class made up of international organizations, diaspora remittances, free funds, export retention proceeds, and loan proceeds foreign currency earners, who use what Gresham's law refers to as good money, which is the Nostro FCA balances, while the rest of the public is relegated to the use of the bad money, which is RTGS balances. However, the fiction remains that their relationship is one of parity, 1:1 as announced by the Reserve Bank. Yet it is clear to all and sundry that with the huge shortage of foreign currencies, electronic and RTGS transfers, which are not backed by any physical cash, have a much lower value as reflected by the premium on physical cash on the thriving parallel market of foreign currency. Those currencies deemed RTGS balances cannot be used for external payments and will continue to lose value due to inflation. In essence, therefore, this categorization effectively reinforces the inherited distorted dual and enclave economic structure. It would appear lessons from the hyperinflationary era have not been learned, where as a result of the erosion, the effective destruction of the Zimbabwean dollar, ordinary citizens and the working people lost value through bank deposits, insurance premiums, and pensions contributions. This prejudice, which led to the establishment of the retired Justice Smith Commission of Inquiry into the conversion of insurance and pension values from Zimbabwe dollars to United States dollars, is playing out again, this time under the multi-currency system. The ZCTU notes with concern that the collection of the intermediated money transfer tax to all electronic financial transactions is regressive in that it negates the very essence of such platforms that were established to promote financial inclusion. Taxing the formerly financially excluded poor people, especially in the rural areas and urban communities, is highly regressive and retrogressive. Moreover, this comes at a time when the central bank has been promoting the use of plastic money, electronic mobile money payment systems by the Zimbabwean public. Clearly, therefore, this regressive tax is at odds with the vision of the monetary authorities to create a cashless society by 2020. It should not be lost to Zimbabweans that we have been here before, as government railroaded the populace into ESAP in 1991. We need to recall the lessons learned, if any, so that we are the wiser going forward. If therefore national ownership engendered through stakeholder participation is a critical success factor and key lesson from past experience, then what is unfolding in Zimbabwe under the so-called new dispensation is most worrying. How do we expect to succeed when programs are being rolled out without stakeholder participation? How can Cabinet approve a macroeconomic and fiscal stabilization program without stakeholder participation and ownership? As ZCTU, we urge the government to institute comprehensive stakeholder consultations as the basis for moving forward and addressing the myriad of challenges bedeviling the economy, and negotiate a social contract as the basis for recovery and inclusive, broad-based growth and human development. An institutional framework to promote such stakeholder consultations, the tripartite negotiating forum, is already in place. We have seen what the new fiscal and monetary policies have done in terms of prices Everything has gone up, and I think all of us, all citizens, are experiencing it, and it is devastating. The ZCTU is therefore calling on all Zimbabweans to join the ZCTU in national demonstrations across the country on Thursday, 11 October 2018, against the ill-advised measures that have a devastating effect on the lives of Zimbabweans. Zimbabweans must come out and demand a reversal of the 2% per dollar tax that has caused high prices hikes. We are simply saying no to another ASAP. Once again, I thank you for attending the conference. Thank you.